Hi, do you know the feeling when you've done all the homework on an investment idea? You covered every angle, every worst case scenario, you weigh the risk reward, make your call, and wait for the rally to start any day now. And what actually happens? The stock crashes another 15%. Your downside risk plays out, not your upside catalyst, and you're staring at drawdowns, questioning your process and wondering, was that a good call? Well, good luck asking your AI to decide that for you. Let's get back to first principles. What Marx says, investment success doesn't come from buying good things, but from buying things well. Means process is still key. Agreed? But hindsight, yeah, that's a pain in the. I'm Prithviraj Saya. You can call me Raj, and I run a equity research consultancy firm. I want to tell you the story of a high conviction idea that's gone wrong for us. It's something every smart investor would face eventually, but it's personal too because we felt it not just intellectually but with our wallet. So it's a fun discussion to have with friends, mainly because of the super high side it offered with such a short time frame. You can call it gambler's instinct, if you will. But having said that, we are still in it for good reason, we think. I've got two questions for you as we go through this case study. First is a reflection. Would you have taken that bet if it came to you with the same uncertainties that we faced? Secondly, like I said, we are still in the game. So the follow-up question is, what would you do next? Would you double down, double the energy, given what I'm going to tell you now? What's your conviction level now? Is it high after looking at MTM losses? Uh, let's get into it, but two disclaimers before we do. One, your investment decisions are yours. I'm a SEBI registered research analyst. Two, uh, we are going to nerd out a bit on financial nuances here. You don't get to see me dance. It's just charts and regrets. Here's a bird's eye view of our work so far. QFIN is an online loan facilitator based in China, a market leader in online retail and consumer loans domain. But it was impacted by a regulatory event in 2025. So QFIN and peers had fallen by almost 30% from July to first week of September. And in September first week, we wrote a note saying why it was not so bad. It was a bullish note, and we expected a short-term relief rally to previous peaks. But things changed in October, and we revised our views on October 20th note based on new facts. Our new note is more conservative in terms of timing of the recovery, but we are still bullish. All right, getting into the details now. First, the background. NFRA, the Chinese financial regulator, came out with a notice in April 2025, capping all borrowing costs at 24% all inclusive for retail customers, and also said no predatory pricing, no manipulation in name of various add-on fees and so on. This was to be effective from April 1st of this year. To be honest, the April ruling was not taken seriously enough by many experts. But that changed in July when the government officers inspected NBFCs, lenders, and so on. And investigations started to explore all the unfair practices that happened in the market, like add on memberships and predatory pricing uh, uh, and conditional loan approvals. So the market knew in July that the regulator was not messing around and that loans above 24% threshold are a no-go. From then on, up to September, QFIN fell by almost 30% because investors had feared that the business model itself was broken. So that's the context for our first call in first week of September when we said the regulatory overhang sets up 100% upside post clarity, which is post October 1st when we are talking in September. The base case impact was 15 to 20% on earnings, and the worst case was around 30%. But even the worst case was okay because the stock was down by already 30% already, And our main argument being that asset quality issues are temporary and earnings impact is one off. In other words, we were expecting bad results already in 3Q and 4Q, but we expected asset quality stress, which was seen in 2Q, to be more moderate or to get better based on what we understood about the QFIN's financials, credit assessment standards, and their conservatism. They had many good things to boost off as well. They had one of the best capital returns in the financial space, still do. They are market leaders. Their net cash, and they have the capacity to lever up on the balance sheet if they need to. And they traded at 1.2x price to book, half of the valuation just a few months before then. All right, so this was my simplified pitch in the first week of September. Let's say the regulatory clarity comes through on October 1st, and that's your reset button. Let's also say the asset quality does not worsen from 2Q because one, regulators are sensitive to the systemic shock that their actions will cause, so they provide smoother solutions, transitions, people give people time, right? We also think the asset quality will hold up because of QFIN's track record in its credit assessment, and the guidance clearly implies they are micromanaging this aspect, right? So adding this up, we said our short-term bull case, we expect a 60, 80, 100% upside. Right in October, maybe worst case November, once the regulatory clarity comes and the asset quality holds up. But cut to October 10th, post the Golden Week holidays, and we are in trouble. QFIN fell by another 15% in October. We spoke to managements and experts, and with a sad face, we had to say, let's curb down our enthusiasm. So, what exactly happened in the first 2 weeks of October? First week was Golden Holidays, and when everyone was back, we heard that the regulators were silent. No action, no talk. This was by default the hard line on October 1st as the cutoff date for capping the 24% loans. No smoothing, no transition. The bigger problem was that the asset quality only worsened. You see, over the months, funding to high-yield borrowers tightened as NBFCs and loan facilitators like QFIN became more compliant with the 24% ruling. And it is usually the case that borrowers with this credit profile are dependent on loan rollovers. They pay one loan by taking over another loan, right? And this is how they afford the EMIs. So cutting down on funding turned out just the right button to trigger delinquencies. The result seems to be a lot worse than what most people expected, even in worst case. So if I were to confess to a fault, maybe we underestimated this contagion effect, but it was not black and white, was it? So where does that leave us? We know that asset quality pressure undermines the earlier bull case. If you look at the graph on the side, if you zoom onto this graph, you'll see that the net profit or the margins are inversely correlated with the asset quality metric called C2M2. It's the loans overdue in the second month. We expect this ratio to peak in 4Q of 25 and then start bottoming out more in 1H of 26. Another watch item is increased scrutiny on various membership fees and programs, but it's a tangent. It may still have a tangible impact based on regulatory actions, but still secondary to the asset quality cycle that we're talking about. The bottom line is a 30% or more impact on earnings in 3Q and 4Q, and combine that with a very bad sentiment on asset quality. Despite the gloom, though, we have a decent plan of sorts in our mind, and this is how it goes. It is still true that earnings impact on from lower loans is a one-time event. Next year, the loan growth can resume on a lower base. Secondly, and more importantly, as you know, asset quality is the single most important thing for financial firms coming out of a bad cycle. And we believe that QFIN's asset quality can recover in 2Q or 3Q of 2026. What makes us say that? For one thing, the average loan tenure for QFIN is 3 to 4 quarters. So as QFIN rolls over the current vintage of loans, which are under delinquency pressure, as they keep the leash tight in terms of underwriting only good quality and better quality loans, which they say they already are doing, and they are taking the pain in 2H, they will naturally evolve the loan book of a better quality as we move into 2026 second half. What more, QFIN is known for its best-in-class credit assessment with proprietary alternative data, industry-leading tech, uh, and they have a track record of coming back from bad phases across cycles. This graph you see is the same asset quality and margins graph we saw previously just now, but you can see historically QFIN has been able to come back every time the asset quality worsened. The current phase looks a bit like what happened in 4Q21 and 4Q23. And if you investigate what happened there, you'd see that they have seen this story earlier and came out only stronger than before. Add on QFIN's other modes, things that have not changed because of the current phase of events. Uh, for one thing, it is a market leader. It can take market share from smaller players as they exit the market driven by this tough cycle. It still has the best ROE and profitability profile among peers. QFIN also has one of the best shareholder-friendly policies among financials in general. Its share buyback plan has almost 600 million in dry powder. Its cash dividends account for more than 6% on the current share price. And finally, as you know, balance sheet strength is a must for financial firms in transition. And what does that mean for QFIN? It has significant net cash balance, almost a third of its balance sheet or market cap, sorry. It generates a significant FCF year on year, and it can use this balance sheet to grow as well because they find their leverage is significantly below industry norms right now. So all these things combined, we still believe in a turnaround, except it will likely happen by the end of 2026 or maybe mid of 2026. So what's our actionable? We say it's a bit too early to position for a turnaround that may happen a year down the line, maybe half year down the line, especially given the current environment. Rather, we have to wait for the signs that the current asset quality cycle is bottoming. Uh, Hope we get an even better price while we wait. And I personally feel this is one of those companies, right? If you have a long enough time frame, the probabilities of a positive outcome only increase because QFIN is gonna stay. It's gonna be around 5 years down the line, and it will still be a market leader in that time. So it's a matter of waiting out this cycle. So you heard me now. So tell me, would you have taken that first bet? I bet most would say no. But here's a follow-up. Is hindsight a bitch? It definitely is 2020, right? Or is it more like wisdom mixed with regret? That said, my current bet is more constructive, a higher probability one, don't you think? Comment below. Or if you're an introvert like me, just DM. Completely fine. I appreciate all the engagement with my work. And I hope it was not too technical. You don't need to be an analyst to have a view. I hope it was more like a brain teaser. I'm Raj, and I run an equity research firm advising and supporting hedge funds and institutions on high conviction ideas, the kind that we just discussed now. And hopefully, I'll see you with the next one soon. Yes.